This hearing of the Subcommittee of Financial Institutions and Consumer Credit will come to order. Good afternoon, and thanks to all of the witnesses for agreeing to appear before the subcommittee today. Today's hearing, which is entitled TARP Oversight, is TARP Working for Main Street? We'll examine whether TARP has been successful in freeing up credit for American businesses, especially the small and medium-sized firms that are vital to the U.S. economy. We will be limiting opening statements to 10 minutes per side, but without objection, the record will be held open for all members' opening statement to be part of the record. I yield myself 5 minutes. Last week, in his first speech before a joint session of Congress, President Obama stated, "The concern is that if we do not restart lending in this country, our recovery will be choked off before it ever begins," end quote. I imagine that few will argue against the proposition that unfreezing the credit markets and reinvigorating lending to American businesses is how we find our way out of this recession. Resuming the flow of credit to the businesses on Main Street so that those firms can retain existing employees and even create new jobs is exactly what this TARP Oversight hearing is about. Specifically, we will focus on whether the TARP funds distributed through the Capital Purchase Program, or CPP, have been successful in freeing up credit for American businesses, especially the small and medium-sized firms that are vital to the U.S. economy. The impact of the CPP funds on small banks, small businesses, and lending to Main Street deserves examination because small firms are the backbone of the American economy. Small businesses employ about half of the private sector employees in the United States and pay nearly 45% of the total U.S. private payroll. In my home state of Illinois, more than 49% of the workforce is employed by small businesses. Since the mid-1990s, small businesses have created 60 to 80% of the new jobs in the U.S. and have traditionally led the nation out of recessions because small firms tend to recover faster. I supported TARP and the Emergency Economic Stabilization Act that created it primarily because I felt it was necessary to unfreeze the credit markets and get capital flowing again. But under no circumstances do I want the money to be held in the vaults of Wall Street firms to be used for executive bonuses or to pay shareholder dividends or to be hoarded in cases these institutions were threatened with insolvency. When announcing the creation of the Capital Purchase Program, former Treasury Secretary Paulson stated, quote, "Our purpose is to increase confidence in our banks and increase the confidence of our banks so that they will deploy, not hoard, their capital. And we expect them to do so. So increased confidence will lead to increased lending. This increased lending will benefit the U.S. economy and the American people," end quote. Congress must ensure that TARP and CPP funds are being used in ways that are consistent with the intent of those programs. If these programs, which could place a large financial burden on American taxpayers, are not working in ways that benefit U.S. businesses and consumers, then we should revisit the manner in which they are being implemented before the Treasury Department divides the second $350 billion in the same way they did the first. Some critics of Congress' involvement in this area argue that we are setting out to force banks to lend or encouraging banks to make bad loans. This is a straw person argument. I'm not interested in encouraging banks to make bad loans. I understand and support the current environment of stricter lending standards because even under those strict standards, there are thousands of businesses across the country that can qualify for loans. Furthermore, I believe that those same strict standards should be applied to financial institutions. In other words, if banks will not lend to businesses that have made bad business or investment decisions, then likewise, Congress should not invest in taxpayer dollars and financial institutions that have made bad investment and business decisions and which are, quite frankly, credit risks. Rather, we should reward those institutions that have made sound investment decisions and stand ready to make loans in rural and urban areas all across our country. It is time to shift our primary focus away from saving the Wall Street firms that got us into this mess and concentrate on the Main Street and community-oriented firms that know how to create jobs and grow the economy. Without a vibrant small business community, this recession will linger longer. Investing in small and medium-sized firms is one of the fastest routes we can take to economic recovery. I look forward to addressing these issues during this hearing. I will yield the ranking member, Mr. Henseling, 5 minutes for his opening statement.
Thank you, Mr. Chairman, and thank you for holding what I believe is truly a very, very important hearing. People all across America have questions about the TARP program. The hearing is entitled TARP Working for Main Street. I think clearly most members of Congress think that it ought to. Whether or not it is frankly an open question. Now, when we ask, is TARP working for Main Street, we have to really take a look at what TARP was designed to do. And frankly, that is a difficult question to answer. Because if you look at the congressional, the enabling statute, TARP was told to, number one, protect taxpayers. It was told to provide financial stability to our financial markets. We were supposed to help struggling families in the law, help retirement security, stabilize communities, and the list goes on and on. One can argue there were a lot of different competing goals in TARP, and sometimes when you charge a statute with many things, you charge it with nothing. Now, if the purpose of TARP was to give large financial institutions a capital cushion at a time they vitally needed it, I suppose some people could argue maybe it worked. I don't know. And unlike the chairman, I did not support the statute, although I think it's important that government act. I think there is a legitimate crisis. I think there is much pain within our society. And I'm heartened to hear the comments of our chairman that a lot of the solution lies within our small businesses. I believe many members of Congress believe that ultimately the road to recovery does not lead through the halls of Congress. The road to recovery does not lead through Wall Street. The road to recovery leads through the small businesses of Main Street. And so again, as we question, is the program working for Main Street? One, I think we have to look, how do we judge this? It's frankly difficult, and as a member of the Congressional Oversight Panel for TARP, there continues to be a regrettable level of our lack of transparency within the program, very few metrics of success, very little accountability, and frankly, no articulated plan that the vast majority of Americans, much less the markets, understand. And I say that about both administrations, the current administration and the previous administration. So what we have in some respects is, at least the second tranche of TARP was $350 billion in search of a program. Now we know that the president, as of yesterday, included $750 billion for son of TARP, grandson of TARP, whatever we call it now. And again, we don't have an articulated program. Now, I try not to read too much into one-day swings in the stock market, but clearly, since the administration has come to office, there's been a loss of approximately 15% in the Dow, and I think part of it is because the administration has failed to articulate a plan, which is frankly the same mistake that the previous administration made as well. If we want the best way, again, to get out of this economy is to help empower small businesses. Small businesses employ the majority of Americans. 3 out of 4 new jobs are created by small business. But they need certainty in the market. There's so much capital sitting on the sidelines, but they're waiting to find out, is somebody going to bail me out? Are they going to bail my competitor out? Are they going to bail my customer out? We need some legislative and regulatory certainty. People need to know what the rules are. We can't have a program also that is picking winners and losers. That is not going to help our small business. If TARP gets into the business of saying we want to help the auto industry, but we don't want to help the trucking industry, we don't want to help the software industry, that's picking winners and losers. People are concerned about throwing good money after bad. You know, AIG is now in for their 4th involuntary contribution of taxpayer funds, Citi in for 3, BA 4. GM has now come back 3 different times. So we need a program that will help our small businesses, our struggling families, and where necessary to use federal funds to close down failed financial institutions and launch new ones, but we need to do it in a way that doesn't send the bill to future generations that will decrease their opportunities, their job opportunities, their home ownership opportunities. And Mr. Chairman, I appreciate again you calling this hearing. I yield back.
Thank you so much, Mr. Hensarling. I look forward to working with you over the next 2 years. I have Congresswoman Maloney for 3 minutes.
Thank you, first of all, and welcome to all of the panelists. I congratulate Chairman Luis Gutierrez on his new chairmanship and Ranking Member Jeb Hensarling on his, and I look forward to working with both of you. We certainly have our work cut out for us. What I've been hearing from my constituents is that our credit markets remain frozen, people are having trouble getting loans, and unemployment is rising. That is not to say that TARP has not had benefits. Its first step was to stabilize our banking system and to stabilize our economy, and it was successful to a certain degree in that area. I do want to note that a constituent of mine will be testifying, Robert Davenport, who is the president of the National Development Council, which is one of the oldest national nonprofit community and economic development organizations in the United States. Thank you for your work, and thank you for being here. One of the concerns that the public has in having trust in the TARP system is transparency. They are saying they want to know where their dollars went before more dollars are allocated. I have asked Chairman Bernanke. He says this information is out there. Yet I would like to place in the record a letter from Professor Stiglitz, who points out that he cannot find this information, and a lawsuit filed by Bloomberg, who says they likewise cannot find this information.
Without objection, so ordered.
And currently, if I could say this, I think it's important to note that the TARP data are presented in filings in over 25 different federal agencies now, including filings with the Security and Exchanges Commission, Federal Reserve registration data, FDIC, over-the-counter trade data, Commodities Future Trading Commission. The data sources required to perform transparency for the TARP initiative is not only housed in different agencies, but incompatible systems and formats. It is impossible to track this information. That is why I have introduced the TARP Accountability and Disclosure Act, and this legislation would require the Secretary of the Treasury to develop a centralized database that will be the repository of how this money is spent after it has been provided to a financial institution, so that we can track this information and know if it is being successful, not only in stabilizing our financial institutions, but in getting lending going, the wheel of our economy, of getting lending out into our communities and helping our economy go forward. I urge my colleagues to look at this legislation and hopefully join me in co-sponsoring it. And again, congratulations, Chairman, and I look forward to working with you and the ranking member.
Thank you. The gentleman from Delaware is recognized for 2 minutes.
Thank you, Mr. Chairman. Let me just say I agree with all those who've spoken, and I think that their words are well taken. And I believe very strongly that there is just not sufficient, and we keep using the word transparency, but understanding of exactly what has happened here. I think most of us can track and follow those banking institutions, be they holding companies or banks directly, which have received money. We have charts to that effect. We can even look at some of their lending patterns, which stay roughly the same if you look at the last 3 months of last year. But it becomes very difficult to track exactly to whom those loans have gone and exactly how that money is being spent and accounted for, nor do I know if it is. I don't know if a banking institution has loaned an extra $50 million to whom it has loaned it other than GM or somebody of that nature, and exactly how it's been spent. And I just don't think we have that information, which is one reason I look forward to this hearing today. I think it's vitally important that not only members of Congress, but that the public understand this. I've watched this stock market just collapse here in the last several months, and I think a lot of it is just a lack of understanding of what is going on out there. And we need better information, better presented in terms of what is happening. You may make the argument that not only the banking institutions, but other institutions are raising money, are in some way or another raising capital, and for that reason are more stable than perhaps we think they are. But at this point, there's just a lot of doubt in the minds of a lot of people, even beyond the Congress of the United States, who just aren't sure what is happening. I don't think anybody can make a conclusive argument that TARP is working or not working. So what you're going to present today and the answer to your questions is vitally important to all of us, and I think we have an obligation to make sure that there is a public understanding of all this, and I'm glad to see the Fed has at least started to move in that direction. I yield back, Mr. Chairman.
Gentleman yields back. Congressman Sherman from California for 2 minutes.
Thank you. I usually focus on whether taxpayers are getting a good deal in TARP transactions or whether there's been undue generosity toward Wall Street. We've all been outraged by the dividends, the compensation, the perks, and the Congressional Oversight Panel demonstrating they get shortchanged by $78 billion in terms of receiving less preferred stock than we should have. I've also been concerned about taxpayer money going to foreign entities, as appears to be the case with the transfer of tens of billions of dollars to AIG counterparties, including what appears to be substantial transfers to foreign entities. Today we focus on helping Main Street, and there are two ways that TARP can do that without going through Wall Street. One is the use of the TALF to have the Fed make loans. Now, true, some of these may be generated originally by large banks, but they could also be from small banks, and increasingly we could see federal agencies making the loans themselves. The second is to use community institutions. I look forward to seeing how we can better use community banks. And I want to comment about credit unions who want to make small business loans. They need capital, and they're turning away deposits. They can't issue preferred or common stock because of their nature. They could be allowed to issue subordinated debt, which is much like preferred stock. And if they could sell, if we in Congress authorize them to do so, they can sell the subordinated debt either to the TARP program or to the public, get the capital, accept deposits that their members want to make, and make small business loans. The other thing we need to do is to explicitly authorize a greater amount of small business lending by credit unions. So I look forward to seeing community banks and credit unions get us out of a recession that they clearly did not put us into. I yield back.
Gentleman yields back. I'm sorry, Mr. Klein for a minute and a half.
Thank you very much, Mr. Chairman, and thank you for holding this hearing. Last week, the Oversight and Investigations Subcommittee held a hearing on the TARP Oversight, and this is an important follow-up to those proceedings. Many of the witnesses here today will be discussing the need to improve lending to small businesses, and it's clear from today's testimony that we'll hear that the TARP program, and I think from the experience we've had in speaking to our neighbors and friends back home, is largely failing to unfreeze the credit markets and allow creditworthy businesses to access credit on reasonable terms. And certainly nobody is asking anybody to make loans that are not creditworthy. But it's clear that the pendulum has swung wildly to the other side and has hit the wall, and it's unfortunately not lending itself to allowing these types of reasonable loans to take place. I certainly agree with the recommendations to take concrete action with certainty to ensure businesses can obtain the credit that is essential on the successful operation of their enterprise. Small businesses tend to lose jobs faster as the country ends a recession, but they also tend to recover faster with a little more flexibility and adaptability and emerging from a recession. So it's even more essential that we find substantial ways to help these small businesses access the credit which is their lifeblood. Elizabeth Warren, who's the chair of the Congressional Oversight Panel, testified last week, quote, "If this TARP program is about putting money into the hands of small businesses, then you make that part of the terms of receiving the money. And if someone doesn't want to do that with the money, then don't let them have the money. It's that straightforward." Seems pretty simple to me as well. And I think her comments are absolutely correct, and I look forward to the testimony so we can help work together to flush out the ways to restoring the flow of credit to our small business community. Thank you very much, Mr. Chairman.
Thank you, Mr. Klein. We are pleased to have before us today witnesses representing a small business, a community bank, a community development financial institution, two noted economists, and a financial consultant. Testifying first is David Sharfstein, Ph.D. of the Edmund Cogswell Converse Professor of Finance and Banking at Harvard Business School. Next is Dean Baker, Ph.D., the co-director of the Center for Economic and Policy Research. Testifying third will be Robert Davenport, President of the National Development Council. Next is Rusty Cloutier, the President and CEO of Mid-South Bancorp, located in Lafayette, Louisiana. Following him is Bert Alley, the founder of Ellie & Company, based in Alexandria, Virginia. Finally, we have Mr. Joseph Sicaro, who is the owner of Mr. Beef Deli in Chicago, Illinois. Mr. Sharfstein, you may proceed with your testimony.
Good afternoon, Chairman Gutierrez, Ranking Member Henserling, and members of the subcommittee. Thank you for inviting me to speak today. My name is David Sharfstein. I'm a professor at Harvard Business School, a research associate of the National Bureau of Economic Research, and I'm also a member of the Squam Lake Working Group on Financial Regulation, which is a nonpartisan, non-affiliated group of 15 academics who have come together to offer guidance on the reform of financial regulation. But I speak only for myself today. I'd like to make three main points. First, there's likely been a contraction in the supply of bank loans because of the poor financial condition of many large banks. This poses a challenge for most firms, but particularly for small firms, which rely on bank loans for almost all of their financing. About half their loans come from large banks, and these banks appear to be cutting their lending more than our small banks. Thus, it's important to find ways to ease the supply of credit to small firms. Second, the Capital Purchase Program of TARP should be thought of as two distinct programs. One is a support program for large troubled financial institutions, some of which are systemically significant. The effect of this program on financial stability and credit availability is hard to measure since we cannot observe what would have happened in its absence. The other part of the CPP program is targeted at small banks. This program is not a support program for troubled financial institutions, but rather a program that provides capital to banks so that they can increase their supply of credit. The effect of this program will be somewhat easier to measure, but such measurement will inevitably be imperfect. Third, and at the heart of my testimony, the government should consider expanding the Capital Purchase Program for small banks, perhaps even creating a separate program for them. The problems of the big banks have no easy solutions, and it is highly uncertain how and when their problems will be resolved. In the meantime, small firms risk losing their primary source of funding. Many small banks are well positioned to step into the breach, given their knowledge of local markets, and with an infusion of capital could do so. However, as with any government program, one must ask, why does the government need to be involved? In this case, one should ask, why can't banks with good lending opportunities raise capital on their own? The answer is that many can raise capital, but are reluctant to do so in the current financial environment. Given extreme investor uncertainty about the health of the banking sector, a bank that issues stock is likely to be perceived as one that is undercapitalized or is unrecognized losses on its loan portfolio. So it is natural that banks have been reluctant to issue stock on their own, given that doing so would likely drive down their stock price. In addition, most small banks are privately owned and cannot easily raise capital in illiquid markets. The government's commitment to purchase stock at a premium would entice small banks to participate in the program and raise capital, as many have already done. This program will attract more banks if it does not include the same sort of restrictions that are now imposed on TARP recipients, nor should it. This program would not be designed to put taxpayer dollars at significant risk. The program will be most effective if it targets small banks that are able to leverage the equity investment by expanding their deposits or borrowing. And it should target banks with expertise in business lending. Research I've done suggests that the existing TARP investments in small banks do appear to have gone to banks that do more business lending. It would be tempting to require participating banks to reach a target level of new lending equal to some multiple of the government's investment. This temptation should be resisted. Mandates of this sort could result in a rash of bad loans, and we do not want to turn healthy banks into unhealthy ones. Moreover, we should probably not measure the success of the program purely on the basis of whether there is an increase in lending. It will be a success if the increased lending capacity of small banks increases competition and puts downward pressure on interest rate spreads, which are now at high levels. Of course, it is important to keep in mind the limitations of such a program. Some of the hardest hit communities may also have many troubled banks. Investment in these banks may help stabilize them, but that's not the sort of investment I have in mind. Moreover, while many small banks are relatively healthy now, their condition could worsen appreciably. In that case, the investments are unlikely to have the desired effects. With these limitations in mind, I believe that the government should enhance its program of investment in small banks, targeting healthy banks that are well positioned to increase lending. At a time when large banks appear to be retrenching, this would better enable our financial system to meet the pressing needs of small enterprise. Thank you for the opportunity to address you today, and I look forward to answering any questions you may have.
Thank you for so rigidly following the rules of the red light. Everybody has 5 minutes. When you see the little yellow light, that means you have about 30 seconds to wrap it up. Mr. Baker, please.
Thank you. Thank you, Chairman Gutierrez and Ranking Member Henseling, for inviting me to speak here. I want to make three main points in my comments here today. First off, agreeing with the Chairman's opening.
Mr. Baker, could you pull the microphone a little closer? Thank you.
Okay, I'm sorry about that. There were two distinct purposes, motivations behind the creation of the TARP. One, the stabilizing of troubled banking institutions, and secondly, restoring the flow of credit. And those are two very distinct purposes. A second point I want to make, and I perhaps I'm out of line with some of the other witnesses here and some of the other comments, but I think the main cause of this downturn is we're misplacing it if we see it as being in the financial system. I think the main cause of the downturn is a loss of $8 trillion in housing wealth. And I'll make a couple comments on that, but I think we would be misleading ourselves if we thought simply restoring the flow of credit would be sufficient to get the economy going again. And then the third point, agreeing with many of the comments just made, I think that the Treasury and the Fed can and should try to target TARP money and other aid to smaller financial institutions, because many of those are best positioned to resume the flow of credit, which certainly will help with the recovery. Now, as far as the first point, just to recap the history that you all recall very well back in September and October, the pressing need was the urgency that the Treasury Secretary and the Federal Reserve Board Chairman came to Congress and said we needed TARP. The pressing need was that interbank lending had ground to a halt. The LIBOR rate, the spread between the interbank lending rate in London and the 90-day Treasury rate had expanded to almost 5 percentage points at its peak. During normal times, it's typically between 15 and 30 basis points. So we basically had a freeze of interbank lending, this being between the major banks, simply because no one could trust that these banks would be in business 90 days out. We're only talking about 90-day loans. That, to my mind, was the urgency, the main purpose of the TARP, and certainly I think members of Congress have been right in pressing for more transparency. The taxpayers certainly have a right to know where their money is going. On the other hand, getting the money to those banks to ensure that they did not collapse does not restore the flow of credit. And perhaps our best example here is simply the case of AIG, of course, not a bank, an insurance company, but the money that we funneled, the taxpayers have funneled into AIG, is not about restoring the flow of credit. It's simply about keeping a systematically important institution from collapsing. And I think we do ourselves a disservice if we try to conflate the two. Those are not, getting money to AIG does not restore the flow of credit. My second point was that the downturn is first and foremost due to the loss of wealth. We've lost on the order of $6 trillion of housing bubble wealth. We're on our way to losing on the order of another $2 trillion. This explains the downturn almost in its entirety. The basic story, if you look at the housing industry itself, we've seen a contraction on the order of about $450 billion a year in annual demand due to direct housing, construction, building in the housing sector, residential sector. And then on top of that, the wealth effect that we would expect to see based on $8 trillion of housing wealth would imply an additional about $500 billion in annual consumption. That's sufficient to explain the downturn we're seeing. The impact of the freezing up of the credit system obviously magnifies that, but the basic story is that we had a very large bubble which led to a huge amount of, in effect, fictitious wealth, which has disappeared over the last 2 years, and that is the cause of our downturn. Now, one item I like to cite as evidence that there isn't a problem or the problem is exaggerated of creditworthy customers being unable to get credit is the Mortgage Bankers Association Mortgage Applications Index. If it were the case that creditworthy customers were having difficulty getting home mortgages, we would expect to see that index soaring as people had to apply for 2, 3, or 4 mortgages just to get one. And of course, many people would apply for 2 or 3 mortgages and still not be able to get one issued. In fact, this index has trailed downwards. It's followed host sales downwards, indicating that
creditworthy borrowers are not having much trouble at all getting mortgages. So that doesn't mean to say, I don't mean to say that businesses can never have trouble getting mortgages, but the main factor here is simply the loss of wealth. Finally, on the last point, we know that we have many large banks that are severely troubled. One of the things that's been striking is many small banks have held up very well through this crisis. That's not true everywhere. Obviously, if you're in the middle of a bubble market, you were hit hard. But if we look at the FDIC's data, we see that in the category of banks with assets of $100 million to $300 million, they actually managed to increase their loans modestly in the fourth quarter, a period in which the economy was declining at a 6% annual rate. That suggests that those could be an engine that could move the economy out of this downturn, and I think Congress would be well advised to look to try to get them the capital they need to sustain lending. Thank you.
Thank you very much. Mr. Davenport.
Mr. Chairman and members of the committee, I want to thank you for the opportunity to testify today regarding the effect of TARP on Main Street. I'm Bob Davenport. I'm president of the National Development Council. NDC is an organization that was created in 1968 after the tragic deaths of Dr. Martin Luther King and Robert F. Kennedy. And our mission is very simple. It's to end discrimination and create opportunity in low-income communities. Fundamentally, we provide training, we provide technical assistance, and we do financing in low-income communities. We finance affordable housing, we do small business lending, and we finance a whole variety of community facilities such as medical centers and libraries and educational facilities and youth facilities. We have lots of experience in business financing on Main Street. We are a CDFI and CDE as certified by U.S. Treasury. We're also an SBLC with a license from the SBA. We financed about $500 million worth of affordable housing, and we financed about $500 million of new markets transactions. In SBA, we've loaned just under $100 million in financing to small businesses. Our average borrower is borrowing $300,000. All of our borrowers are on Main Street. It's clear the economic downturn is having a devastating impact on our low-income communities, but also as organizations such as ours who are involved in financing in low-income communities. And we do need another source of capital until the banks return to our market. We need TARP and TALF, we believe, not because we're doing poorly, but because we're doing well. We need to increase our liquidity, and we need to replenish our capital in order to meet the increasing demand that we're finding in our communities as the conventional banks pull back. And here's how the pullback has affected us directly. First of all, I mentioned that we are an SBLC, which means we're a small business lending company. We make SBA guaranteed loans. The SBA guarantees 75% of it. If we make a $400,000 loan, $300,000 of that loan is guaranteed by the SBA. We borrow that $300,000 from a conventional lender. They have a very secure loan. It's 100% guaranteed by the SBA. One of our conventional lenders is a large money center bank that received TARP funds last fall. We had a long-standing relationship with that bank going back to the mid-1990s. This bank had a $5 million credit facility to us. Starting last December, however, they took a series of actions that forced us to pay the loan back. First of all, they raised the rates, which we felt was unwarranted because we had just completed a superlative safety and soundness exam by the Farm Credit Administration, and the SBA's overall risk rating for our SBLC was 1, which places us as the highest grade, lowest risk rating possible. Second, they asked for a direct security interest in the loans that we made. SBA has that security interest, and we would be in violation of our SBA license if we were to give it to that bank. Finally, they said that they demanded that we agree to pay them on any defaulted loan before the SBA pays us. They said that they assumed that all of our small business loans would go bad in the communities we're working in. They wanted to be paid in a timely fashion, and they'd not wait for the SBA. Well, the only way we could meet that condition was by us borrowing from them and not lending the money out so that we'd have the money so we could pay it back if anything went bad. Since we couldn't comply with the conditions, we had to agree to repay them. From their perspective, they didn't turn us down for credit. They believed they offered us credit. We just couldn't meet the terms that they demanded, and as a result, we are paying that loan back. And this all happened after the bank received TARP funds. We've made several recommendations in our written testimony. I won't go into them. Let me just say, if TARP and TALF were available to the 4,000 or 5,000 institutions that are out there, from the smaller community banks that you're going to hear from, to alternative financial institutions such as us, to community development financial institutions, et cetera, and if it was offered to those financial institutions to replenish their liquidity and to increase their capital, because they have made loans and they will continue to make loans, they don't need the TARP funds because they might make loans. They are making loans. These mission-driven institutions have no desire to hoard their TARP funds. They will use the TARP funds to make loans. They'll use it responsibly. Thank you.
Thank you. Mr. Klucher.
Chairman Gutierrez, Representative Hensling, and members of the committee, my name is Rusty Klucher. I am President and CEO of Mid-South Bank Corp. Mid-South is a bank holding company located and headquartered in Lafayette, Louisiana, with total assets of approximately $940 million. Through our wholly owned bank subsidiary, Mid-South offers complete banking service to commercial and retail customers in both South Louisiana and the entirety of Southeast Texas. Mid-South Bank, like the vast majority of community banks, did not engage in the risky subprime lending practices that are at the heart of the current crisis. As a result, Mid-South Bank is healthy and well capitalized and is in a strong position to help this economy recover. Mid-South Bank lived through the deep recession, or as I call it, depression, that ravaged the economies of Louisiana and Texas in the 1980s. We are terribly experienced in helping to revitalize an economy when the large financial institutions have failed. It is important to distinguish the capital purchase program available to community banks from other TARP programs. The capital purchase program funds are only given to healthy community banks. On the other hand, too big to fail institutions do not have to be healthy to receive TARP money. In most instances, they receive it because they are not healthy. The CPP program is not a bailout for community banks. Mid-South must pay an annual dividend of 5% on the $20 million in preferred shares we purchased from the Treasury, along with the grant of stock warrants. Community banks participating in the program have relent the money in order to cover the cost of this capital. Mid-South heeded the call by Treasury and banking regulators to participate in the TARP capital purchase program because we believed it was our patriotic duty to participate in CPP to help stimulate the economy. When Mid-South accepted the $20 million in CPP funds in January, we viewed the government's investment as a public-private partnership that President Obama has talked about to promote lending. We began to actively promote the availability of $250 million in loan opportunities to small businesses and community leaders through town hall meetings in 18 communities in South Louisiana and Southeast Texas. We focused on small business because they drive the economy and create new jobs in our communities. In addition to the general business community, we are also reaching out to the minority business community through town hall meetings with the Black Chambers of Commerce in Baton Rouge and Southwest Louisiana and the Group of 100 Black Men. We have also a billboard campaign underway throughout our markets aimed at small business and the general public, letting them know we have $250 million to lend. While attendance at these meetings have been good, there seems to be a reluctance among the audience members to take on significant amount of new debt. This is true despite small business loan rates at least 2% lower than a year ago. The reluctance of the borrower is probably due to an uneasiness about the general economy and due to the drop of the price of oil, which is an important driver of the economies of Southwest Louisiana and Southeast Texas. Given the state of the economy and the tough regulatory environment we live with, it is harder for community banks to find borrowers who are currently creditworthy. Despite the challenging lending environment, we believe that our outreach efforts have paid off. Our level of lending for consumer and business remains about the same as this time last year. We believe that is quite an accomplishment in the midst of the most serious recession. Since receiving the CPC capital infusion in January, we have made approximately $13 million in new consumer and commercial loans and $7 million in mortgages. We're especially proud of 2 new small business loans made by Mid-South since receiving the CPP fund. These loans to 2 small oil-field service businesses will create over 50 new jobs in South Louisiana and Southeast Texas. As Mid-South Bank has shown, community bankers have the know-how and the desire to use the CPP funds to support economic recovery in the communities throughout the nation. Mid-South Bank does not engage in compensation practices found at some of the larger TARP recipients, which have understandably created a public furor. We are frustrated at being tarred with the same brush as these large institutions. ICBA believes that compensation restrictions and new corporate governance regulations should be focused on the larger TARP recipients that have undermined the public confidence in the Treasury's recovery efforts. If the government changes its agreement with Mid-South by adding new burdensome conditions, Mid-South will have to reevaluate its continuing participation in the CPP program, as our hometown competitor, Iberia Bank, did when it paid back the CPP funds this week. It would be a shame if new burden conditions force Mid-South to withdraw from the program, because Mid-South has proven itself to be a responsible partner in the effort to revitalize the economy. I will be very happy to take your questions.
Thank you. Mr. Ely, please.
I got it for you, Bert.
Yes, bring the microphone up.
Yeah. Mr. Chairman, Mr. Ranking Member Hersling, and members of the subcommittee, I very much appreciate the opportunity to testify today about TARP and whether it is working for Main Street. I've appended to my written testimony answers to the 8 questions posed in the letter of invitation to testify. As will be readily evident from my answers, I am not a great fan of the TARP. Further, I greatly fear that the TARP will become a vehicle by which Congress will impose credit allocation policies on TARP investees. Such policies would be very destructive to the American economy. My early consulting experience is especially relevant to the subject of this hearing, as for over a decade I consulted to small and medium-sized businesses on a broad range of financial matters, including obtaining bank credit. I also worked with business insolvencies. Those experiences brought home to me the importance to small businesses of having sufficient equity capital on which to safely leverage bank credit. Lending standards clearly are returning to earlier prudent standards from the excessive laxness of recent years. That return to prudent standards is crucial, both for the recovery from the current recession as well as for the longer-term health of the American economy. This is absolutely the wrong time for Congress to force banks to, whether through TARP rules or otherwise, to launch a new round of imprudent lending, whether to small businesses or homeowners or whomever. With regard to lending to small businesses, it is important to realize that the primary reason why a business cannot obtain credit it believes it needs is that it lacks sufficient equity capital and or it cannot demonstrate to the lender that it can profitably employ the credit being sought. It is vitally important to realize that credit is not a substitute for equity capital. Rather, credit can only be reasonably leveraged off of a sufficiently strong equity capital base. In this regard, non-financial businesses are no different than banks, except that for good reason, non-financial businesses cannot operate with as much leverage as banks and other financial intermediaries. Because lending standards are returning to normalcy, businesses of all types cannot operate with as much leverage as they could a few years ago, nor should they try. The underlying cause of insufficient credit for businesses, including small businesses, is inadequate equity capital, as I've mentioned. Rather than beating on banks to lend more, Congress should address the tax incentives working against equity capital accumulation within businesses. To put this another way, the Internal Revenue Code is the principal underlying cause of the current financial crisis. I addressed the tax laws and 10 other public policy causes of the crisis in an article which will appear shortly in the Cato Journal. I'd be glad to submit that article for the record when it appears in print later this month. While there are many aspects of the tax laws which fueled the housing bubble and the gross over-leveraging of the American economy, working together they encourage businesses and individuals to over-leverage by incenting overspending and undersaving, thereby discouraging the accumulation of capital denominated as equity. That is, rather encouraging savings which builds equity on a balance sheet, the tax laws actively discourage savings and equity capital accumulation through the relatively heavy taxation of profits, for profits represent the generation of equity capital. At the same time, the tax deductibility of interest expense by businesses and homeowners encourages borrowing and therefore over-leveraging. When the pre-tax cost of equity capital is easily 15% or more and the prime rate is 3.25%, as it is today, it is an apparent no-brainer for business to finance as much of its balance sheet as it can with that capital. and as little as possible with equity capital. In addition to funding a portion of a business's bank balance sheet, equity capital also serves as its loss cushion, the same role equity capital plays in bank balance sheets. That loss cushion becomes vital to a business's survival during a recession, for it is equity capital, not debt capital, which must absorb any business losses and serve as the foundation on which borrowing during tough times must be based. Far too often I have seen business owners seduced during good times by seemingly cheap debt, only to suffer losses during the tough times that exhaust their too thin equity capital foundation. I will close this portion of my testimony by posing this thought experiment. What would be the condition of the American economy today and the availability of credit for businesses of all sizes if interest was not a tax-deductible business expense and business profits were not taxed at a business level? I strongly suspect that America would not be in recession and that it would enjoy a much more profitable and much less leveraged business sector than it has today. I will close by discussing a potential threatened loss of bank capital and therefore reduction in bank lending capacity. The 20 basis point deposit insurance special assessment that the FDIC has proposed to levy on the nation's banks and thrifts this coming September 30. This assessment represents a $15 billion tax on bank capital and would occur as the government is trying to boost the banking industry's capital and lending capacity. As FDIC Chairman Sheila Bair has admitted, this assessment would be pro-cyclical, yet she is determined to levy it. I recommend the Financial Services Committee express its opposition in the strongest possible terms to this most untimely attack on bank lending capacity. And with that, I thank you for your time, and I welcome your questions.
Mr. Sakara, I just want, for the record, to state I've known Mr. Sakara for over 20 years. I've been at his business, let me see, in the summer, the winter, in the fall, always a long line, many, many people. I just can't understand how a thriving business like that cannot really, I mean, there's so much demand at his place. Any season of the year, anybody from Chicago knows. So, yeah, all politics being local, I did invite a local business person. But you want to know something? He is so representative of what is wrong with our current banking system. Mrs. Sakara, please.
Good afternoon, Chairman Gutierrez and the Ranking Member Helslinger and members of the committee. On behalf of myself, my business partner, Michael Genovese, and my attorney, James DeCristofano, I thank the committee for inviting us to participate in this crucial hearing. I sincerely believe it is essential that during this tumultuous time that the voices of small business owners are heard and those struggles are reported. I'm the owner of Mr. Beef on Orleans. We have been there in the city of Chicago for 30 years. We have built a reputable reputation and a thriving business. In addition, I am the owner, along with Michael Genovese, of an apartment building and an Italian fine dining restaurant named Natalino's, also located in the city of Chicago. We opened that in March of 2008. Combined, both restaurants employ 50 hardworking people. We provide much of the needed sales tax receipts for the city of Chicago, Cook County, and the state of Illinois. We source all our food and our products from small business purveyors. This economic downturn has had its impacts on my business due to the loss of jobs, income, and from local residents that live and work in the near downtown Chicago. Many small businesses are being starved of needed lines of credit or are having their lines of credit not renewed upon maturity. Not only have I seen and heard this from a variety of small business owners, and I have personally lived out this nightmare. I have two loans that are relatively small that have matured in October and November of last year. These loans have been paid every month, and I continue to submit payments. I do not have the funds to give the entire loans that are amount due. Midwest Bank, which received $85 million in TARP funds, will not renew or extend the mature loans further. This places my business and my properties in jeopardy. Another bank will not refinance the two mature loans because the new bank will be placed in a third lien position. Thus, the banks want us to try to obtain funding to refinance all the loans at Natalino's and Mr. Beef. This has severely hampered our nonstop efforts to find financing or a resolution to our problem. Small banks do not have the capital to take on this loan. Again, big banks are not even the slightest bit interested and are using the TARP money to inflate their own revenues. We have been actively submitting loan packages to various banks and loan brokers in order to extract us from this situation. Our current loans are approximately 55 to 60% loan to value based on recent appraisals. Our loans carry interest rates right now of 8.5% and 9%. Current rates are at around 6.5 to 7. By lowering our rates would provide a dramatic savings to our business, would prevent us from letting go of any more employees, and would also give us breathing room to ride out this economic turmoil. Midwest Bank frustrates me in that they receive TARP money and are not willing to either extend our loans or lower our interest rate on the non-mature loans. They have been patient with us while we seek alternative banks to finance us, but in reality that means nothing. Many bankers seem to be paying us lip service and are not actually interested in providing financing, but rather seeking free publicity. We've been dealing with one small bank for about 6 months. We've been giving them documents, we've paid for expensive appraisals, and tried to accommodate every request they make. To this day, we have been constantly given optimistic outcomes that they have increased our hopes that an end is near to our situation. Yet, they have not approved or denied any loans. My situation is just one example. I am fortunate to have a successful business in downtown Chicago. There are other business owners who are not that fortunate. At the end of the day, we are at the mercy of the banks who have no willingness or obligation to help us. I was approached by a local banker whom I knew, and he found out that I was coming here to testify in front of this committee. He strongly suggested that I should not appear. I should ride out the economic problems and wait till this all blows over. I politely asked him to give me the $84,000 a year that lower rates would save, and he promptly walked out of my establishment. I do fear backlash within the local banking industry for coming here today. I implore this honorable committee to set my mind at ease. I do not need, nor do I need a bailout from the taxpayers. I only want the banks to be fair and refinance our loans. Congress needs to take action. Congress needs to know that small businesses drive the economy, that we are fighting every day to keep our doors open and keep our people employed. It is time that TARP funds come with requirements that the banks must actively seek out and help lower small businesses' interest rates or extend their mature loans or their lines of credit that are performing. On behalf of myself, my partner Michael Genovese, my attorney James DeCristofano, and all the small businesses that run the economy, I thank Chairman Gutierrez and the members of this committee for the opportunity to come here today and tell our story. I welcome all questions from the committee.
Thank you very much, Mr. Sakara. I'll open up with 5 minutes. First of all, Mr. Sakara, I want to thank you for what I know is a difficult task to come before the committee and tell your story, and for the courage that it takes. I know you're very fearful because of what the financial institutions and the kind of repercussions by complaining about them might cause you and your business. Since you're here, I'd like to make clear to everybody just what's going on so that we can see. So Midwest Bank holds how much in loans to your businesses? What's the total amount?
$335,000.
So $335,000, and those loans matured, is that correct?
They matured, yes.
They matured. And they won't refinance those loans?
We asked them to refinance, they wouldn't.
And they received $85 million in TARP money?
Yes, they sent us a letter saying that they received $85 million in TARP.
Let me ask you something. Were you ever late on any of on a loan during the time you had the loan with them?
1 second. No, it just matured.
Okay. And let me just ask you something. Even though they said they haven't, they're unwilling to renegotiate any new terms, have you continued to pay the loan?
We continue to pay the loans in full amount.
So you took out a loan with Midwest Bank, you paid it on time every month, the loan came to maturity, they refused to renegotiate the terms of the loan, you were never late, and you continue to this day to pay the loan and the amount of money owed to as you try to renegotiate.
Yes, we submit the payments in.
So let me ask you, what do you think the place on Orleans in downtown Chicago is worth? I mean, Mr. Beef is
In a
a
bad
nice
market.
humble for those. It's a nice humble establishment, but it is what it is. But I just wondering, what does that land in such a critical place of the city? I mean, the real value there must be not the building, but the land. What do you say?
Our last appraisal, which was, I think, done in November of 2008, was about $3 million.
$3 million. So that's where Mr. Beef sits on a piece of land worth $3 million, and you owe them $300,000 on that loan that they refused. And what's the value of the other property? Because there's two of them. There's the other restaurant. What's the value?
1523 Chicago Avenue is, I want to say, about $3.1 million.
So you have appraisals for $6 million. Is that correct, Mr. Sakar?
I'm sorry, it's about 5.3.
Okay,
Combined.
$5.3 million.
Both properties are combined.
And what is the total amount of money that you owe? This is everything, the $300,000 that won't be renegotiated by, and the other permanent financing that you have. What's the total amount?
About 3.4, 3.5 million.
So we see that he isn't over-leveraged. He has appraisals for $5.3 million in an economy where real estate is losing value every day. He owes $3.4 million or thereabout in total amount. And we give somebody $85 million in TARP dollars, and they won't renegotiate. And it isn't though you're paying. What's the interest rate that you're paying to Midwest?
8.5 and 9. We also threw in private homes on that were.
And of course, you also secured this with
Also
your own private
home.
homes and the private homes of your other business partners, in addition to what the appraisals are. And 9%. I mean, just so that we understand, that's what he's paying, and he's paid it faithfully. I think that is what we need to understand. It isn't giving small businesses loans so that they won't be repaid to the financial institutions, but we hear this story day in and day out in my office, and I know in offices across the United States of America, that people who have thriving businesses, the choking of the lines of credit is such that it is causing our economy harm. Even if you have a business that makes money, they will not extend to you the credit, unless, of course, you go outside the regular banking system to even more onerous interest rates in order to get this done. I don't think that's where we want to take America in terms of where our small business is. I just want to thank you, Mr. Scow, again, for coming and testifying before this committee and telling your story. I have other questions for other members of the panel, but now I will go to Mr. Henseling for 5 minutes.
Thank you, Mr. Chairman. And Mr. Cloutier, maybe we got you a new customer here. I don't know. It's against House ethics rules for us to take a commission, so it'll just be a public service. Maybe the two of y'all can meet after this hearing. I'm not a banker. My background is not in banking. Not unlike Mr. Zuccarov, I was a small businessman for 10 years before I ran for the House of Representatives. At the recommendation of our chairman, Mr. Zuccarov, certainly look forward one day when I'm in the Windy City to go to your restaurant. If that doesn't violate House rules, then I'd be happy to have you buy the Italian sausage. Frankly, I have no idea, Mr. Zuccarov, whether you are the greatest credit risk in America or the worst credit risk in America. I have no idea. It's not my area of expertise. The gentleman sitting 2 seats to your right probably is his area of expertise. But before I ask my questions, I think there's a very important point to be made for myself and for a number of members of Congress, and that is we want to empower banks to lend credit to credit-worthy individuals. We do not wish to cajole, browbeat, mandate. With all due respect to all of my colleagues, with few exceptions, I don't think there are many people here who probably know how to run a bank. Just like when we were in our hearing with the CEOs of the 3 auto manufacturers, I must admit I was a little amused at how many of my colleagues wished to tell them how to make cars. We don't know how to make cars. We don't know how to do this. We need to empower you to do your job. Now, Mr. Cloutier, a question for you. I believe in your testimony you said essentially that if certain provisions of TARP were changed in the funding agreement for the under the capital purchase program, that your bank would rethink its participation. Previously, the House passed a bill, the Senate did not take it up, that would have defined provisions with respect to the second tranche of the $350 billion. Included in that House-passed bill was a provision that allowed the federal government to put an observer into your boardroom, and all those who indirectly benefited from the TARP money, which ostensibly would be your customers as well. If that passed the Senate and became law, would that be a troublesome provision to you?
If that became law, I think you would have basically all 400 community banks returning the money. Most community banks most probably are thinking about it very seriously. When the Treasury came with the program, and you remember the CPP program came by Mr. Paulson after he realized he didn't have enough money to buy toxic assets. He came up with this idea of putting money in the healthy banks to try to help regenerate the economy. They were counting on 2,000 community banks taking the money. It's now down to 400, and those banks are starting to return the money. So the answer to your question is yes, I would anticipate that we would return the money, and most community banks would.
Mr. Ely, in your testimony, you state that you have a fear that TARP could become a vehicle by which Congress would impose, quote-unquote, credit allocation policies, which I guess I read as lending mandates. Could you tell me, in your long-standing history within the industry, what are your fears, what historic precedent are they based upon, and what would you see as the consequences of such actions on the part of Congress?
Well, first of all, there's I think a mistaken idea that the banks are being given TARP money. They're not being given TARP money. The government is making an investment in the banks. It expects to be repaid on that with what effectively is interest in the form of dividends, and hopefully the taxpayer will not end up losing any money. So I think it's very important to realize that there is not a present here. Second of all, banks don't lend very little in the way of capital. Their capital serves primarily as a loss cushion. Most of the money that banks lend is actually the deposits that they bring in and their borrowings from institutions like the Federal Home Loan Bank. So I think that it is a mistake to somehow equate a TARP capital investment, which is there to strengthen the bank's loss cushion, with its lending activities. But there seems to be a lot of talk about that, and that we might end up with some kind of lending mandates being imposed on banks. There certainly has been that discussion, which I find unfortunate because it leaves out the fact that banks have been increasing their lending. The Federal Reserve data on this are very clear that banks have been increasing their lending, even though we are now in a recession and many potential borrowers are actually cutting back on their borrowing. So in my opinion, the banking industry has been performing as a whole exceptionally well in increasing its lending at a time of economic distress. And I would think that if lending mandates are put in place, to follow up on, as Mr. Cloutier said, that you will find a lot of banks are saying, this just isn't worth it. We're out of here. We're going to buy back that preferred stock we sold to the Treasury Department.
Thank you.
Thank you. Mr. Moore, for 5 minutes.
Thank you, Mr. Chairman. The TARP program set up by the Treasury Department and the Federal Reserve to provide liquidity and stability in the financial marketplace. Are there additional steps or changes in any of the current programs that the federal government should consider to ensure credits flowing to our small businesses? Mr. Ely, do you have any comments on that?
Well, I think that in the short term, there are a lot of small businesses that are going to have to hunker down in this time and live with the fact that credit standards have tightened. things did get too loose, and what the small businesses have to focus on is trying to raise equity capital so as to improve their creditworthiness. And I realize that this is a very difficult environment to do that, but I also don't think it's wise in this economy to encourage banks or to force banks to make risky loans. And that is, of course, the real concern that flows from the notion of lending mandates, that banks are going to be forced to make loans that they otherwise would not. Keeping in mind that banks are in the business of lending. This is how they make money. And we shouldn't assume that banks are just sitting on the TARP money and not looking for lending opportunities. They are, but in this environment, they want to understandably make good loans. And I could add one additional point. What I hear from bankers across the country is that they are getting a lot of criticism from their bank examiners, the folks out in the field, about the riskiness of their loan books. And so there's a lot of pressure coming from that element of the bank supervision establishment to actually cut back on the riskiness of their lending. And that may be the situation at Midwest Bank. I don't know.
Mr. Cloutier, do you have any different thoughts?
I would tell you that I have a good friend in Louisiana that says that the big banks get the gain and we get the pain. And, you know, let me be honest. As I nicknamed them, the miserable eight that appeared before here, that most of them are insolvent now. We went through this in Texas and Louisiana in the 80s. You got to deal with the insolvent institutions. The regulators in Congress have been very slow to do that. The pain is going to take a much longer period of time. And I would tell you there's two things you learn in the banking business very early on. One is concentration's a bad thing. And what we've done is we've concentrated all the assets in this country in deposits in the 8 hands to about the tune of about 64%. And that goes back to the late 90s when I testified in this room in front of Congressman Baker's subcommittee in this exact committee room, and we brought that up when it was getting out of hand, and they were well aware of it. The second thing is, in the banking business, you learn very early, your best loss is your first loss. And keep pumping money into these big banks is causing a lot of problems. And I'll just tell you, the community banks out there, we are second-class citizens. We know it. Mr. Tim Geithner said it the other day when he testified before the Senate under questioning from Senator Kay Bailey Hutchinson. He said point blank, we're going to take care of the big eight. The community bankers have to take care of themselves, and it's unfortunate.
Sir, let me stop you just a minute, and I'll ask both of you this question if we have time to are there additional steps or changes in any of the current programs that Congress has set up now that the federal government should consider to ensure credit is flowing to our small businesses? What can we do to make this credit flow so we can get this economy revived and moving again?
Well, let me give you one example. Mr. Ely just talked about it. I mean, I woke up last week and found out that my second quarter profits have totally gone. They're going to the FDIC. I'm going to have to pay a premium of 20 cents, which is about $1.6 million in my bank. My FDIC premium's up 480% since last year because I have to pay the losses that the big banks have gotten. I mean, you know, to feel like we feel like a second-class citizen is an understatement. And, you know, I didn't fly up here on a private jet, and I don't live that way. And but I think the first thing Congress could do is drag the regulators in here, the Treasury and the Secretary of Treasury, and say, what are you going to do for the community banks? We're tired of hearing about saving the big eight. What are you going to do for Main Street? What are you going to do for the people who live, Mr. Gutierrez's district, Mr. Hinderling district, your district? What are we going to do to help the people on Main Street? And that is the real problem. And until that message gets to the regulators, we'll continue to feel the pain, and they'll continue to get the gain.
Mr. Ely, any different comments?
My comment would be that Congress should resist the temptation to put more restrictions and obligations on the banks that have accepted TARP funds, so as not to drive those banks out of the program that are in it now. Keeping in mind that there are many banks that have purposely chosen not to get involved in TARP in the first place because they don't want these lending restrictions and mandates.
Anybody else on the panel have any thoughts? Are we out of time?
We're out of time.
Thank you, Mr. Chairman.
Mr. Lee of New York for 5 minutes.
Thank you. I may want to take this in just a slightly different direction, but what Mr. Henserling started out with, I thought was right on the mark, and I think we keep picking on Mr. Eli here, but I liked one of the comments that I read in your testimony, and that was the comment, don't push banks to make bad loans. It's a pretty simple premise, but I believe over the years in Congress we've helped initiate some of the problems that we now see today. And one thing that I've just learned over the years in business, and unfortunately I think in Congress we keep trying to think that there's a magic pill that's going to get us out of these problems that we face. And I'm proud of the fact that I have many community banks in my district who have had sound lending practices. They haven't had their hands out there, and they're the ones who are still making loans in my district to, for example, farmers who need cash to keep their operations running. And so I agree with you that the TARP funds, unfortunately, I think in some cases have been misplaced. In getting back to that point on regulation, I'm deeply concerned because unless there's a known bottom to this market, you have a lot of people sitting on the sidelines and not knowing what the rules are, and that applies to banks as well. And I'll start this out with Mr. Eli, and somebody else may also chime in. But right now we're toying with legislation on something called cram down. Are you familiar with that?
Yes, I am.
My personal concern is that this, although it sounds, or the idea was to have good intentions, in fact it'll have the exact opposite. I believe that by allowing bankruptcy judges to have the power to rewrite or modify your primary mortgage would be very detrimental to the market and to banks. My concern is I think that it would raise interest rates and it'll further eliminate the flow of capital. And I'd like to hear your thoughts on that.
Well, I have those same reservations about the cram down. The essence of the cram down provision would be to empower the bankruptcy courts to modify mortgage terms on a primary residence. And what that would do is increase the uncertainty in lending on mortgages, and banks and other lenders would have to take this into consideration in their loan pricing going forward. Now, the talk is that the cram down would only apply to loans that were made by a certain date. But once Congress did that, then it would be reasonable for lenders to assume that in the future you might have a similar provision, and so it would be actually unwise of them not to assume that as a new risk in lending. And what this would do would be to hurt those who are the most credit constrained in borrowing, and it would have the effect of pushing up or pushing down minimum loan-to-value ratios on loans, requiring higher credit scores, and making it harder for the credit constrained to borrow. I also have another concern that goes back to my years of doing bankruptcy work, and that is we have several hundred bankruptcy judges in the country spread across many district courts, 12 or 13 appellate circuits. It would take a long time for case law to develop through the courts as to what was an appropriate mortgage modification, what was not. And what I would be concerned about is during that time, which could be for many years, that you would have great uncertainty across the judicial circuits as to what was appropriate or not appropriate in a cram down, and that would add even more uncertainty into the mortgage.
I think we're opening up Pandora's box in doing so.
Very much so.
Let me one question from Mr. Kluche, and I apologize, gentlemen, that we're not trying to pick on these two gentlemen, but if we set TARP aside, is there anything else that we can be doing legislatively here that would help your bank?
I think the number one thing you could do to help my bank and to help all the community banks in America is to separate it into two categories: large financial conglomerate institutions and banks. The people in New York are not banks. You know, I mean, I know they give them titles at Goldman Sachs and Morgan Stanley. They're in a different league from me. As I like to tell people, they playing in the NFL, and in the communities I service, I'm down at the junior high school level. You know, and that's the difference. And I think when you lump them all together, when Congress says, well, the banks did this, the banks did that, this is not the people in your district, Mr. Lee. I know your district. We have a future chairman coming out of New York. You know, he runs a little $80 million bank up there. He's not the same as the boys at Goldman Sachs.
Thank you so
and Morgan
much.
Stanley. So I think if we look at a little different regulations for the size of the institution and the complexity, and realize that when you talking, it's Congress I'm talking about, not you individually, I think it would make a huge difference, because the people
The time
in
of the
community
gentleman
don't
has expired,
understand.
Mr. Clinton.
Thank you.
Thank you. Mr. Baker, I want to thank you, since I know that we promised you we'd get you out of here by 4:30. Unfortunately, there were a few votes that delayed us. So you are, we thank you, and whenever you have to leave, please feel free to leave, and we thank you for your testimony. We look forward to speaking to you again soon.
Okay, I appreciate that very much.
You're very, very welcome. And next we have Mr. Sherman from California for 5 minutes.
Thank you. Let me just respond to Mr. Eli for a second. To think that if we pass a bankruptcy law in 2009 applicable to mortgages written in 2008, that somebody in 2015 is not going to make a mortgage loan because they wonder what Congress will do if there's a national financial panic in 2020 means that apparently nobody in the lending business knows much about politics or government. How we respond to the economic panic of 2025 has almost nothing to do with what Congress does in 2009. I don't know what the politics will be. I don't know if the Democratic Party or Republican Party will be in existence. So if somebody wants to make loans in 2020, assuming that they know what the law is going to be in 2025, I don't think reading the history books of 2009 is going to tell them much. I do realize it would be unprecedented, but I, for one, can't tell you what the law is going to be in 2025 with regard to cram downs, or how Congress is going to react in 2015.
May I respond? I think the concern is not what happens in 2015 or 2020, but what happens in 2009, 2010, 2011.
Well, if somebody makes a loan
fresh.
in 2010, they're not going to be doing the same subprime they used to. But if we pass a law in 2009 designed to deal with the abusive lending of 2008, and somebody makes a legitimate loan in 2010, I'll tell you I do know enough about politics. We're probably not going to pass a cram-down law in 2011 applicable to mortgages written in 2010. I'm not going to ask for your response because you're the expert, except when it comes to predicting Congress. Then we don't really need to bring in outside experts to give us advice.
Excuse me, Representative Sherman, if I could just comment on that very briefly. I think actually the effect that was referred to here by Mr. Ely is exactly what you'd want, that in the event we saw a sort of crazed period of lending as we actually had in 04, 05, 06, we would precisely want the banks to be worried that Congress might take action to make it more difficult to collect those loans. That was what we want. It would be great if they had that concern.
I'm not looking for that particular fear, and I certainly don't want them to not make a good loan because they're worried that 2 or 3% of the good loans they make are going to go bad, and then there's going to be cram down for those. I would hope that cram down would exist only for laws prior to enactment, and that is what the statute before the Congress would provide. And yes, it takes the unprecedented and makes it precedented, but it certainly provides only the slightest bit of guidance as to how Congress is going to legislate with regard to mortgages issued in future years. The focus of a lot of attention is why aren't the banks lending? And there are a few benign reasons for that. First, I remember the good times of 2 or 3 years ago. Constituents would always be coming to me telling me their dreams are being crushed because nobody will make them the loan they want. So we start with a background base of people who would be disappointed even in the best of times. We then have the fact that up until very recently, lending standards were way too loose. So a lot of people were getting loans that shouldn't have. Then everyone is a worse credit risk now than they were a year ago. And finally, the banks themselves, or the big banks at least, are somewhere between insolvent and undercapitalized. So the big banks are still lending more money than they're getting from TARP. They're lending less money than they used to. And I have no way of calculating whether they're lending more money than they would have had there not been a TARP. But the bigger issue is not, are they lending more than they would have if we hadn't adopted the program, but rather, how do we configure a program that dollar for dollar imposed on the taxpayer gets you the most in lending into the economy? Mr. Baker, how would you compare taking the next $100, $200 billion of TARP money and giving it to the big banks in one form or another versus going to Bernanke, who has basically said he'll do TALF-type programs? We take 10% of the, if we put up $10 billion, he'll go out there and lend $100 billion. Which provides the most? I'd ask that the witness be able to respond.
Sure.
I'll just be very quick, and I would say, follow from Mr. Sharfstein's testimony, that I think you want to distinguish between money that's going to keep essentially insolvent institutions alive for systematic purposes versus lending. And I think your priority, I think very reasonably, is on lending. We obviously have to deal with systematically important institutions, but that's a totally separate issue.
Congressman Marchant for 5 minutes.
Thank you, Mr. Chairman. My question has to do with the distribution of the TARP funds among the large banks and the small banks. And I had some information I reviewed before I came to the committee that gave a list of all the banks in America, all the financial institutions that had received the money and the amounts. And am reading with great interest this trend, Northern Trust and bankers that are coming into my office, and in the testimony we're hearing, that the small banks and many of the banks are the healthy banks are really going to give the TARP money back at their earliest opportunity because they don't like the restrictions that are involved with it. The real, I guess this may be more of a philosophical question, is if the TARP money was distributed across America to financial institutions basically not necessarily according to their need and their risk factor, but so that it would be distributed pretty well to affect lending across America. If you begin to have the healthiest banks and the small banks and the healthiest institutions give the TARP money back, and the way I understand the legislation, if the money is repaid, I don't think it goes into the Treasury and then pays the debt down. I think the money comes back into the system, into the TARP system, and then the TARP system then gives the money back out, so that you could have a situation where the healthiest institutions give the money back into TARP, and then it begins to be distributed then to the least healthy institutions, and in a matter of time, there's no need for new injections of TARP, but all of the money flows and gets concentrated in the institutions that are the least able and the least likely to then lend. And I'd like some reaction to that.
I'll take a shot at it. First of all, the administration, at least initially, did set some minimums as to who they would invest TARP funds in. Basically, there was a belief, and I think an understandable one, that TARP funds should not go into really weak institutions that might be on the verge of failure, that instead those institutions ought to be merged into stronger institutions. Although there's been a lot of criticism of it, I think that's essentially what drove the PNC acquisition of National City. But as I understand how TARP would work, and given what the limit is in the ESA legislation, if monies are paid back into the Treasury from, let's say, the Northern Trusts of the world, that that is money that could be reinvested in other banks, but with the proviso that it wouldn't go into really weak banks. So possibly you might find that at the end of the day, not all the TARP funds would be invested, or they would be available for investment outside of the banking industry.
Ms. Sharpstein.
Well, I think it's extremely unfortunate that the TARP program, as Mr. Cloutier was saying, was set up as there's a part of it that's a big bank bailout, if you will, a subsidy to banks that are systemically significant, and we don't want those to go under. And then you've got a set of healthy banks that have also received capital. I think it's important to separate these programs. And I think the problem is that, putting lots of restrictions on the smaller banks, I'm agreeing completely with Mr. Cloutier about, I think that's a real problem. And I don't think the subsidy to the small banks is a big one. I think that they're basically sound institutions, and the kind of transfer that is occurring from taxpayers to large institutions is a much bigger transfer than anything that is going to the small banks. And so I don't think it's appropriate to have the same level of restrictions on the small banks. In fact, there's a FDIC program that guarantees the debt that's issued by banks. The small banks haven't opted into that. And I think it'd be a good thing if they could opt into a program where they could get the equity from the government in I think a newly designed CPP program for small banks, and then leverage that equity by borrowing potentially with government guaranteed debt. So I think it's important to be able to invest in healthy banks that have the capability to leverage that capital, and then also to have experience and exposure with business lending.
Thank you, Mr. Chairman.
Thank you. Your time has expired. The gentlelady from New York, McCarthy, please, for 5 minutes.
Thank you, Mr. Chairman, and thank you for having this hearing. Let me first say that in the bankruptcy bill that's going out, the camp down all the language has been changed, so that basically it's going to be out at last resort, because many of us were very nervous last week about how that language was, and we changed the language. That's why the bill was actually pulled last week. And as far as the TARP money goes, if a bank refuses to take the TARP money, it goes back into the Treasury. Now, the Treasury's business is to lend money to banks if they need it. So it actually is coming back into the system and not going wasting taxpayers' money. But, Mr. Davenport, it's basically you that I wanted to ask. I understand from your testimony that nonprofit organizations cannot presently participate in TARP through the capital purchase program because they are not structured to issue warrants or accept equal investments as required under CPP. It seems to me, however, that the community financial institutions like yours can make sound and efficient use of TARP funds. How can we work with the Treasury Department and the Federal Reserve to allow community financial institutions to participate on terms and conditions that make sense within the nonprofit structure?
Well, that's actually very simple, because we are a nonprofit. We cannot issue shares of stock or warrants. But in fact, we issue debt every day of the week. The large money center banks that do finance us, and we at any point in time have approximately $15 million of lines outstanding to them. It's all in the form of debt. We have debentures of various terms and maturities, and I think that the type of debenture that we are able to issue as a nonprofit entity is completely consistent with CPP or TARP in terms of the terms and conditions that would ensure that the debt was paid back, that it had an interest rate attendant to it, that we were willing to live with the conditions that were imposed upon it.
You know, one of the things on listening to everybody's testimony, and certainly listening to Mr. Sarkaro, am I pronouncing that correctly? We go home, and the stories that we, the members of Congress, are hearing, that people can't get loans, and that's with our small community banks. That is why, you know, many of us sit here very puzzled on hearing that the small community banks are lending out there. But yet, when Mr. Sarkaro was giving his testimony, I noticed that Mr. Baker, unfortunately, who left, and Mr. Sheffestein were watching and listening very carefully, and I was just wondering if you had any input on the testimony that you heard from him on what's going on out on Main Street.
Well, I think if you look at the data indicate that small bank lending has maintained its level. Large banks is a different story. The large banks saw a big increase in their lending right after Lehman Brothers' failure. But that was largely involuntary lending, as a number of very large companies drew down on their existing revolving credit facilities. This was GM, Tribune Company, which later went bankrupt. So there was a big bump up in large bank lending, but then it has come down dramatically in the ensuing 4 months. So, you know, I don't know the specifics of Mr. Zuccaro, what exactly is happening there, but if you look at the data, it seems that small bank lending has maintained its level, and it's really the large banks, and there's a whole problem with the large banks with syndicated lending for large companies. It's a sort of a separate issue.
Now, last week we had the large banks here, and they were saying they were lending billions and billions of dollars out. So if they're lending billions and billions of dollars out, our small community banks are lending money out, then what's going on with our economy? Because it sounds like, as far as the large banks and the small banks, they say they're lending. They're putting billions of dollars out, and yet we're hearing that we can't get any money into the system.
If I could address that, Madam. The Federal Reserve data on commercial bank lending show that bank lending, commercial bank lending, has been increasing over the last year, and even though there's been some recent downtick in it, it's nowhere near as great as the decline in economic activity. Where the problem really lies, as much as anything else, is out in the shadow banking world, and specifically with asset securitization. And that is what the TALF is supposed to get going. So that is where the weakness, the greater weakness is over in shadow banking as versus in depository institutions.
Thank you. I yield back.
Thank you, Mr. Chairman, and I want to also commend you for holding this hearing today, especially focusing on the small business community in particular with the mainstream banks. And Mr. Cloutier, it was mentioned, I mean, I certainly believe it's the small business sector that is going to help lead our economy out of this current economic turmoil that we're in right now. And do you believe right now that the community banks have the liquid capital to help meet the needs of most small businesses in their community? I mean, would receiving TARP funds significantly help that problem for community banks?
I think 30 days ago that would have been a correct statement. I think today, most probably not. You know, two major things have happened. First of all, I think all community banks have lost confidence in the federal government's ability to negotiate with them. We were all told, those of us that took the TARP funds, they're going to do the same thing to you they did in the 80s to the people that did business with the federal government, and then the government reneged on their commitments and ended up being sued. And that's why they put 5C in there, to make sure they could change the rules. Most people took the TARP money believing that the government wouldn't do that they had a serious economic crisis. It seems like the government has just ignored that. The second thing is this FDIC premium is hitting all the banks. I mean, I talked to many community banks today. Is one of them told me, I'm going into a foxhole right now. You know, I'm never going to be criticized by my examiners for not lending, for not expanding my bank. And, you know, if the government, the FDIC made a decision this week that the capital and all the banks, the community banks in America, now will put the use of the FDIC to take care of the losses that are going to be entitled that are coming. And that scared the hell out of bankers. So, I mean, there is no more strategic planning. There is no more long-term focus in banking because you can't. It's just impossible when things change that fast.
Well, and it was touched on earlier about the concern that the FDIC's, the proposed premium increase, was going to really hit community banks pretty hard, and that was going to be a significant challenge. Is that a significant challenge for community banks right now, as you see as a resistant fact to not, in terms of respect to lending?
Oh, absolutely. I mean, what happened is they took all the earnings out of banks, so you did away with the safety net. If you've got any loan losses now, it's coming out of your capital. It makes a very difficult situation. And, you know, when community banks hear, well, you know, we're going to bail out the big banks, but we're not going to put any money in to bail out the FDIC fund. And, you know, I would tell you the money's going to return to the TARP program, I think, in great numbers. And I guess the money will be available to go to the Big Eight because you're not going to get any community banks showing up to borrow. And I think they're going to be very worried about adopting any of these other programs. You know, I'll just tell you, I think the community bankers and I think small business in America feel like they left out of the conversation, be it at the White House, be it at the Treasury, or be it in Congress. I'll tell you right now, my 18 meetings I've had around Louisiana and Texas, I can tell you they feel left out. Because every time they look at a picture, it's all the Wall Street people and it's all the New York people showing up at all the meetings, making all the conversations. And when they look at the president's economic panel, it's made up of GE and everybody else, and no people from Iowa, Nebraska, Texas, anywhere else. So I think they feel left out, and I think they're hunkering down, and I am very concerned. I'm going to be honest with you.
Well, I've certainly heard from many banks in my community, Mr. Chairman, that are concerned about paying millions and millions of dollars of unexpected costs, potentially in these premium increases, and that's going to further, as you mentioned, they're going to hunker down, and that's not going to restore the confidence of Main Street, Minnesota, or Minnesota's across the United States, for that matter, and that's where we really do need to focus, I think, to make sure we come out of this economic crisis. I should just ask one final question. You know, it's not just capital that is going to be potentially lent out from banks in terms of liquidity, but how are deposits right now? Have deposits increased as consumers hunker down? Are they increasing their deposits at your banks?
Let me tell you what worries me a lot. I spent an hour on the phone yesterday with a customer that wanted to take out some serious money. And, you know, I thought he was taking it to another bank, and his concern was how good is the health of the FDIC? You know, what is inflation going to look like? I mean, you know, there's a lot of concerns out there. I mean, I deal with I go from one crisis to the other pretty much on an ongoing basis, and I know many of your bankers in your state of Minnesota. I spent a lot of time up there. It's a great state, and I would tell you they are very concerned up there also.
Thank you, Mr. Chair. Yield back.
Thank you. Mr. Gutierrez, that's why we're here.
I understand. And look, and I greatly appreciate I greatly appreciate the invitation. Thank you so much.
We think you're important. I just want to go quickly out of order for 30 seconds. Mr. Sharfstein, so just so that we get this clear, Mr. Ely says they are lending, the big banks are lending, and your point is?
Well, if you look at the data, I mean, it really does look like the large banks had an initial bump up in kind of involuntary lending, but it's coming down. The data is very hard to track in some ways, because a lot of the lending most lending that banks make is actually in the form of extending lines of credit, which are not well reported in the Fed data. And I think a reporting change would actually allow us to better measure the actual extension of credit, so we could see it. If you look at the data, it looks like it's actually coming down.
Thank you. Mr. Scott, for 5 minutes.
Thank you, Mr. Chairman. This is a very good hearing and really gets right to the meat of the issue as far as I'm concerned, because I've always felt that we rush to try to get the right answer without having the right problem presented before us in the very beginning. And sometimes you can figure out, you need to try to figure out how you got into a problem in order to get out of it. And then we got into this, if you look at, we went in with a TARP program, a Troubled Assets Recovery Program that was designed to free up the credits. And somewhere along the line, 2 weeks later, after we left Washington, we come up with another program that we had nothing to do here in Washington. We voted on, called the CPP program. I didn't know what that was. All of a sudden, TARP morphs into a capital purchase program. The next thing you know, nearly $300 billion of that is already gone as direct infusions into banks, and what little guidelines we were able to put on the TARP were applicable to TARP, not to a capital purchase program. So those big banks did what they saw fit with it. So any wonder you come back with them having thrown up $18 billion to themselves in bonuses. And about that time, the auto companies come to us. We never thought of that in the TARP program. Now we're bailing out the auto companies. The reason we're bailing out the auto companies that came before said they can't get loans from the banks after we've given them $290 billion. And as a result of all of this, the question comes down to now, how do we make sure this $700 billion, or what is left of it? And that's one thing I'd like to ask you all from your own understanding of this. How much is left of this? how much are we talking about that's available now? $75 billion is certainly being set aside for housing. You had the $290 billion gone. So much has gone to the autos. Another $50 billion went to Citicorp, and another $45 billion went to AIG. So when you look at all of this, I think it would do us well to try to get an accounting of what we do have left here to work with. And if we're going to bring in the real people on Main Street, that little bank sitting there on Main Street and Rex Street in my district, that's where the auto dealer goes to get his loan. That's where the person who's going to open up a beauty parlor or any other small business, which makes up about 70% of our labor force, that's where they go. I want to ask you, Mr. I hope I don't butcher your name, Mr. Gloutier, is that right?
Perfect.
I want to ask, what is it, can you identify, in order of priority, the challenges that community banks are faced with right now with respect to lending? And then secondly, is there anything that we here in Washington can do with the Treasury Department, whatever moves we can make, to see to it that whatever we have left of this TARP money, whenever somebody can get their hands around what we do have left, to see how we can channel and more directly get this down to the small community independent banks that, in my estimation, will be the saving grace of our economy and our financial system.
Well, I agree with you, Mr. Scott. Of course, I'm a little prejudiced since I run a community bank, but, you know, I would just tell you that, you know, I think to talk to the regulators, tell them that the community banks are the backbone of America. And, you know, I want to make it clear again, and I want to thank this committee so much for letting us, the small banks, have a voice today. And it's not my opinion that we are not being heard. It is the opinion of the American people that when they turn on the television, that's all they see is the automobile execs and the big bankers and whatever. But I think it is to continue to have a vocal dialogue with the community bankers of America, to continue to be engaged with them, to continue to be engaged with small business people like Mr. Zuccaro, to listen to what's going on out there, and certainly work. And I gave Mr. Zuccaro my card before I sat down, and I told him I'll try to help him and go to Chicago. I love the Cubs.
Good. That's very good. Well, thank you very much. Time, gentlemen, has expired. We're going to go to Mr. Ellison, who has patiently been waiting, and then we'll finish up with my friend, Mr. Green. Mr. Ellison, for 5 minutes.
I'll yield the gentleman from Georgia 30 seconds.
I did want to try to get an assessment as to how much money do you think is left, just from your cursory following of the news and the allocation. Where would you say we are in terms of $700 billion?
Mr. Scott, I wish I could answer that, but they throw around billions so fast that even Everett Dirksen couldn't keep track of it anymore, you know?
Just to answer the other part of my question, what I'm after here is I'm after what can we do in terms of the restrictions that we could lift or add, if I may, just one.
Well, it's coming out of my, I gave you 30 seconds, man.
You did good. Thank you. I appreciate it. Maybe you can find another way.
This time back. Yeah. Mr. Scott. Mr. Ellison, please.
Yeah.
Thank you, Mr. Ellison.
Give him a rope. Give him a rope. You want to be a cowboy. Anyway, I want to thank everyone for coming today. I want to also thank the chairman. This is a phenomenal hearing, and it's a long time coming. Mr. Schafferstein, I have a question for you. You've recommended that we infuse and invest more in our community banks. I think that's a good idea and has a lot of reasons, but I wonder if you could flesh your thinking out a little bit more. What do you think is an appropriate level of capital investment in community banks for the government to make? And do you think it should be under the TARP program, or do you have another kind of program in mind?
Well, in terms of how the government allocates the budget, I don't know. I do think it should be a conceptually separate program. The idea that I'm sort of pushing is this notion that if the large banks are under financial stress and in difficulty, potentially insolvent, it stands to reason they're going to be cutting back on their lending. About half of small business lending comes from large banks. And so my thought is that if we can encourage small banks to take the space that is left open by the large banks, the retrenchment of the large banks, that would actually help our economy, help small firms. About 23%, 25% of the assets in small banks, let's say banks under $5 billion, have received TARP money. Okay, I think that there's potential to expand that. But I think the way to expand it is that we've got to recognize that it's not a major subsidy, that it's not the same kind of thing that's going on with the investments in the Wall Street firms, with the big banks. And therefore, it should not be associated with sort of onerous measures. And I think that's the way to get more banks involved.
Well, one difference is that the program you're proposing is really to help small business lending and help consumer purchases and help small community banks do that, whereas the other bank program was a salvage program.
The other program was, had two goals, allegedly. I mean, one was to sort of help out the systemically significant banks. It was to try to keep them sort of stable. The other goal, was to promote lending. But if that had been the goal, we wouldn't have put the money in the bank holding companies, but rather in the actual subsidiary banks to promote lending.
Yeah, Mr. Cloutier, could you kind of react to what you think what you think about Mr. Shepardstein's proposal?
Well, I think there's a lot of good things he's absolutely correct about, and I agree with his testimony completely. I'll tell you one great thing that Congress did do was expand the SBA program. I can tell you that's helped a lot of my customers. It's helped some people get into business. That's a very good program that is working right now, helping increasing lending. And so I think, the problem is going to be to get the community banks again to have faith in Congress, that you offer them some money and they take it. Because I can tell you right now, most of them are just very nervous about getting into any capital arrangements with the government at this moment.
I see. I'll yield back. Well, if I have some more time, the gentleman from Georgia can have it.
I'm ready. I certainly will ask this. This is my final question I want to ask you. I want to ask you this because I think it's very important, Mr. Gutierrez. Can you tell me what impact the FDIC's recent proposed premium increase and surcharge will have on community banks and lending by community banks?
Most of them will give up a great deal of income this year. In my bank, it's about 50%, and I can tell you it's going to make the community banks across America retrench, and because you've given up the safety net of earnings. Mm-hmm. And I know Ms. Bass says earnings are not going to be part of the camel ratings. I don't think anybody really believes that in the bottom of their heart, and so it's going to cause banks to really retrench.
Well, I agree with you. We're going to try.
Time of the gentleman has expired.
Thank you.
Mr. Green, for our final 5 minutes, please.
Thank you, Mr. Chairman. I thank you and the ranking member, both of whom are friends, and I think that this is a timely hearing. Mr. Chairman, I do believe that if you know the truth, it will set you free, and I also believe that the truth can free capital. So for just a moment, I'd like to take the axe of truth and slam it into the tree of circumstance and let the chips fall where they may. Let's talk for just a moment about the CPP program, which was a $250 billion purchase program of non-voting senior preferred shares. I assume that everybody agrees with this. And senior preferred shares were issued such that they qualify as Tier 1 capital. Everybody agrees with this, I'm sure, Tier 1 capital. Now, it's important to know what Tier 1 capital is. Tier 1 capital, generally speaking, is used to protect against unexpected losses. Tier 1 capital, unexpected losses. Tier 1 capital, generally speaking, is not money that a bank lends. Banks make loans from deposits and from money that they can borrow. Some would say they borrow cheap. They borrow from the government, and then they lend that money. So if you have Tier 1 capital that, generally speaking, you cannot lend, larger institutions were in a position wherein they had a problem with reference to unexpected losses that had become expected, because we know that there were runs on banks. And given that there were runs on banks, when they received this Tier 1 capital, it was used to help cause them to become well capitalized. To be well capitalized, a bank has to have a certain amount of what I'm going to call Tier 1 monies in reserve so that they can make loans. The truth is that many of these banks can't make loans because they need to be well capitalized, and they're using TARP monies, which were given to them as Tier 1 monies, to be well capitalized. Now, I just want to deal in truth, because if we're going to fix it, we have to know what we are going to fix. So the notion that we should have lent the TARP money is a notion that in some ways is flawed, because the way it was received put banks in a position where they couldn't lend the TARP monies. Now, Mr. Banker, you help us with this truth, this search for truth, if you would.
Certainly, and Congressman, so good to see you again. I always remember when I testified after the Katrina hearings, and you and I had a good exchange about what was happening during Katrina, and I've always appreciated that. Let me tell you, and in my testimony, if you notice, I said we started a campaign the minute after we got to $20 million in TARP money to loan $250 million. Our goal was to bring in deposits and to make loans. But what has happened pretty much in the regulatory environment is that now they have increased the capital requirements on banks. They're now out there, rather than saying 8% is well capitalized in community banks, they're now talking about 10, 12%. That's what the FDIC did. There's a premium
to do this quickly,
deduction.
People who don't know, if you would, Mr. Banker, that's 8% of
the assets of the bank.
Of the assets of the bank. That's important for people.
Right, assets of the bank. So what they've said now is, well, now rather than 8%, you got to be 10%, so nobody can make loans because they got to keep it all for capital. You're absolutely right, Congressman Green. They have changed the rules of the game. The regulators have said we want more capital, bigger safety net, and now the FDIC is taking away the safety net.
Let me do this quickly because I have to move on. I wanted to bring this out, not to defend any position, not to really stake out a position, but so that we can understand what's happening such that we can lend money at some point. But you have to understand what the problem is before you can solve a problem, generally speaking. Now, I have to move to something else quickly. I'd like to say more about this, and I have a lot more that I could say. But I do want to talk about now something that's near and dear to me called the La Tourette Green Amendment. That's green as in Al Green. And I'm concerned about it because this is an amendment that allows us to have that transparency with reference to how the monies are being utilized. Is there anyone who would oppose banks giving us intelligence about new lending based on TARP monies received? Anyone see a problem with that?
One person can answer that question.
Okay, thank you, Mr. Chairman.
Anybody care to answer this? Mr. Sharfstein?
I'd like to, because I addressed it in my written testimony. You cannot track the flow. The capital comes in on the right side of the balance sheet. It comes in as cash. Cash is fungible on the bank balance sheet. You're not going to be able to track TARP funds into specific loans.
Thank you.
Mr. Chairman, could I ask unanimous consent for 10 seconds?
Sure, for 10 seconds.
All right.
I won't object.
What about tracking simply the amount of increase in new lending? Can that be done?
What you can track through the call reports and through the data file with the Fed are changes in the total amount that a bank has lent at any particular time.
The time of the gentleman has expired. Mr. Cleaver.
Thank you, Mr. Chairman. I always feel the need to let the panelists know that when people are going in and out, it's not because they're bored. We're most of us on two committees, and Mr. Green and I are just running back from Homeland Security, a very important meeting on immigration. So I apologize, and because of that, I will be brief. I'm concerned. First of all, I think we've damaged the credibility of Congress because most people think we voted for Secretary Paulson to give the money to the banks, and as you know, there was never a congressional vote for that. They did that, Mr. Paulson and the administration. So we're trying to, at least create some truth to what happened. I'm interested, particularly Mr. Cloutier. Community banks seem to be doing so much better than the banks that we have labeled too big to fail. So do you think that maybe what we ought to do is to encourage more community banks to participate in TARP so that they will make loans to the small businesses that I think both sides are interested in, because it seems that when we're putting the money in the giants, we lose, the taxpayers lose, and certainly the small businesses lose. I mean, this is a kind of a self-rewarding question, but I need to get a response on it anyway.
You know, I was thinking about Congressman Scott's question too, and yours is almost identical. I would tell you that regulatory reform is going to be something coming up in Congress. I think one thing that I learned in Texas, in Louisiana, and Oklahoma in the 80s is that Congress has to come up with a plan of how to rebuild the banking system. The big bank model didn't work. They sold it to Congress. It was well sold. It was told that if you all go along with this, life is going to be great. Life hasn't been great. It is obvious now. And I think, you've got to go back to the model and look at breaking them up. I mean, as an example, Citicorp today, if they wanted to sell their branches, I know Don Adams would buy them all and put the money up in the morning. And so you've got to relook at the model. So when they come with regulatory relief or regulatory rewrites, I would encourage Congress to very much look at going back to the models of increasing community banks around America, increasing the banks in the states. And I would ask you please to come study what's happened in Louisiana, Texas, Oklahoma. We lived through this in the 80s. Congressman Henseling would tell you that the banks in Texas were destroyed in the 80s, and we rebuilt a very solid banking system through community banks in that state.
One final question. Do you think or maybe this is for any of you, has there been any kind of detectable change since the FDIC insurance was increased from $100,000 to $250,000?
Absolutely. I would tell you that, absolutely, and it was amazing how many people fought that change for years, and then we did it in a matter of a week. But it's made a big change. It's given people a lot of confidence. It's helped keep deposits in the banking system. And, people are looking for a home today that they feel is safe. And, we're just trying to get them to keep it in the banks now and not put it in their backyard because they're very nervous. But, all of a sudden, as I tell my people at the bank, we got this new product called a CD that pays 2%, but at least you get your money back. And people are pretty happy with that today. They really are.
2% is big now.
Yeah. I wish I had some of my money back that I've lost, I'll be honest.
Thank you very kindly.
Thank you so much. I want to thank the witnesses and the members for their participation in this hearing. The chair notes that some members may have additional questions for the witnesses which they may wish to submit in writing. Therefore, without objection, the hearing record will remain open for 30 days for members to submit written questions to the witnesses and to place their responses in the record. I think there's a new bipartisan truth. Small business is important and vital to our economic prosperity and survival, and that we need to work to encourage those kinds of dollars flowing to them. We need to re-examine TARP. We need to look at the new FDIC insurance requirements and the impact that they're going to have. And we need to ensure that we're getting correct data and information in terms of just who's lending and how much they're lending. And Mr. Sicaro, I hope you can stay. I and my staff want to sit down and talk to you a minute too. Mr. Cloutier has been very kind to extend a warm hand of help to you. We want to do the same right after this hearing. Thank you all so much. Without objection, this hearing is adjourned.
Trustee, good seeing you.
Thank you very much. I'm coming to Chicago to see